Hey, I wanted to talk about a little planning idea here for those of you that are maybe in your early 50s or even post 59 and a half, but your plan is to retire at age 62, and you have a health insurance premium issue as to how am I going to pay for this. So we had a situation where we had a husband and wife, 62 and 63, getting ready to retire. They looked at the marketplace premiums and compared to what their COBRA was going to be, and they determined that the COBRA was actually going to be cheaper. And they were just looking at the gross premium cost, under the marketplace. Well, fortunately for this client, we had the wife actually funding her Roth 401k for several years, so we created a pretty substantial balance in that account. So they had maybe a $60,000 need per year of cash flow in the early years of retirement. And this client was also planning on delaying their Social Security to at least full retirement age, if not age 70. So looking at the situation, we said no, there is a better way. And what that better way is that when they do retire, what we'll be doing is we'll be taking some money out of their traditional IRA, and we're going to take some out of the Roth IRA. And most people really think that they're going to fund the Roth, and they're not touching that for a long time. And what I'm saying is no, sometimes it makes sense to actually touch that Roth to control your tax bracket at certain times in life. So what this client is going to do is, say if they have a $60,000 need, but if they're going to do the COBRA, we're going to have to add another $21,000 to it, which, they were going to get a lot of help, on the marketplace. So the plan really is to actually take out about $40,000 or so from their traditional IRA, and we'll take about $20,000 out of their Roth IRA. So my modified adjusted gross income for this client is going to be $40,000, and when you plug that into the calculator for the premium credits, it means that their marketplace insurance is really only going to cost them $300 a month. That's an $18,000 savings, and we're just bridging to Medicare for this, and also bridging to the Social Security age, the claiming age that we're wanting to. And by doing that, we're really taking a lot of stress off of their portfolio. So, if you're planning on retiring at 62 and you're, even 10 years out, you probably need to be looking at, okay, adding that cost of what this health insurance is going to cost if I don't get any premium credits. Now, and so we were thinking, okay, I'll be in a lower tax bracket, once I retire. You may not be, just because of those premium credits. You can actually, improve your situation by funding that Roth, even at what you think is a higher marginal income tax bracket now. But we do have, other stealth taxes, what we call them, like the premium tax credit for the marketplace. So what I see as the risk to this strategy is that, one of the things I've seen is that Biden would like to drop the Medicare eligibility age from 65 down to 60. And, if that's the case, then you would qualify earlier and wouldn't have to necessarily do this strategy. But on the flip side, there's this thing where they adjust your Medicare premiums back based on your overall income. So by funding that Roth retirement account right now, either through conversions or through your payroll contributions into your 401k, you might be able to put yourself in a position to actually control the amount of Medicare premiums that you'd be paying, once you hit retirement, or if you're self-employed, some things that you can do there. So basically, something to consider. If you're planning on retiring at 62, don't just assume you're going to be in a lower tax bracket and you need to hold off on doing any Roth stuff, because it may not be the case when you really get into it and look under the hood and see what's going on. So if you need some help with this strategy, give us a call, or reach out, email. Love to help you with it.